We're heading towards the end of a very busy data week for a number of frontier African economies. On the interest rate front, the Bank of Uganda today left its benchmark rate at 9.75% for the second time in a row, as the country's core inflation paces to 4.2% last month from 3.9%. Now let's get more from the facts behind the rich decision briefing held earlier today by the Central Bank Governor, Michael Atingiego.
6th of February 2025, the Bank of Uganda Monetary Policy Committee maintained the central bank rate, CBR, at 9.75%. Domestic inflation has evolved as previously projected, supported by monetary policy actions and reforms in the interbank foreign exchange market, which have contributed to the deepening of the foreign exchange market and the stability of the exchange rate. Additionally, favorable food and energy prices, along with the relatively low global inflation, have also helped support domestic inflation. Over the 12 months leading up to January 2025, annual headline and core inflation averaged 3.4% and 3.8% respectively. However, annual headline and core inflation in the month of January 2025 rose to 3.6% and 4.2% from 3.3% and 3.9% in December 2024, mainly driven by an increase in services inflation, particularly in passenger transport services. Despite the seasonal rise in food prices, near-term inflation appears well contained. However, the short to medium-term outlook is more uncertain than usual, with risks largely stemming from the external environment. Accordingly, the Bank of Uganda forecasts that average annual core inflation will be between 4 and 5% in 2025. It is expected to stabilize around the target in the medium term. Of course, there are several risks that could affect this inflation forecasts. Inflation could be higher than projected if, 1, the domestic growth is stronger, driven by increased investments in the extractive industry, particularly mining and drilling, and effective government program implementation. Also, the geopolitical conflicts could escalate, disrupting the global supply chains further. In addition, extreme weather events and long-term environmental shifts affect agricultural output, which could result into price hikes. And lastly, if the US dollar appreciates strongly against major currencies, exerting pressure on the shilling, increasing import costs, and posing inflationary risks. Conversely, inflation could be lower than projected if 1, stronger capital flows cause the exchange rate to appreciate. 2, while oil prices decline due to a slowdown in global growth as a result of trade wars. Overall, the risk to inflation outlook are assessed to be on the upside. On economic activity, we see this continuing to strengthen. The business confidence remains positive, despite headwinds from the challenging global environment, as well as the constrained private sector credit growth. The latest quarterly GDP release from the Uganda Bureau of Statistics, UBOS, indicates that real GDP growth in the first quarter of 2024-25 was 6.7%, up from 6.2% in the fourth quarter of 2023-24, and 5.6% in the first quarter of 2023-2024, driven by a significant recovery in industrial activity. Business sentiment suggests that economic activity remains buoyant. Going forward, economic growth is still projected at 6% to 6.5% in financial year 2024-25 and 7% in the outer years, supported by a stable macroeconomic environment, foreign direct investment towards the extractive sector, strategic government interventions aimed at wealth creation, increased agricultural production, and anticipated oil revenues. However, there is still considerable uncertainty surrounding this growth outlook. We see that growth could be lower than projected if we have adverse weather conditions which could hinder food crop harvests, tight financing conditions, and the need for more domestic budget financing due to reduced external financing of projects. Then the global developments, including heightened risks of trade conflicts, as well as disruption of trade and supply chains, which could result into slower global growth. And finally, the global financial conditions, if this tighten due to emerging challenges adversely affecting the Ugandan economy. Conversely, growth could be higher than projected if, one, there is increased investments in the extractive industry, and secondly, government interventions and accommodative monetary policy boost growth beyond expectations. Overall, the risks to the growth outlook are tilted to the downside. The MPC noted that although inflation is expected to rise in the near term, it will return to target in the medium term. Uncertainties from the global developments could cause inflation to rise faster and disrupt economic activity. This situation necessitates a cautious approach to monetary policy. As a result, the MPC kept the central bank rate CBR at 9.75%. The CBR bonds stayed at minus 2 percentage points, and the rate discount and the bank rates remain at 3 and 4 percentage points above the CBR respectively. Therefore, the rate discount rate is 12.75% and the bank rate is at 13.75%. The MPC believes that the current CBR level is adequate to control inflation while fostering Uganda's economic growth and socio-economic transformation. Future adjustments to the CBR will depend on new data and evaluation of risks.